As you have learned, a yield curve generally plots the different yields for different times to maturity within a two-dimensional graph, with the x-axis displaying the time to maturity and the y-axis showing the relevant yield level. Yield curves, therefore, are relatively easy to interpret, but this does not mean they are not important. Their role is one of the most fundamentals in finance. Yield curves are needed to price and value every single financial instrument, from simple loans and bonds to complex derivative instruments. All these instruments are basically a series of cash flows, and the current price of the instrument should simply equal the present value of all these cash flows. Of course, the pricing of more complex financial instruments like options will be different from the pricing of bonds. But for all these instruments, there's a direct link between yield curves, or more precisely the level of interest rates, and their price. Consequently, great care must be taken in constructing a yield curve that will be used to price and value a big part of the bank's business. We have to ensure that the applied curve is accurate and in accordance to the curves used by other market participants. Otherwise, there will be mispricing, which our competitors will be very happy to exploit. Assume you use a too high yield to price a certain bond. Your price is going to be lower than the price quoted by other banks, which will lead to investors buying this bond solely from you. At some point, your short position in this bond will reach a level that is no longer acceptable, and you now want to buy the bond back in the market. And that is when you realize that on the market, you have to pay a higher price than your system shows you to cover your shorts. Let's spend a few more moments to refresh our knowledge on bond pricing. As mentioned earlier, the price of a straight or fixed coupon bond is just the sum of the present values of the single cash flows. Bond pricing therefore consists of the three following steps. At first, we have to work out all future cash flows of the bond, i.e. coupon payments and the redemption payment. Please note that to work out the coupon payments, we have to apply the correct day count and business day conventions. After that, we discount all the cash flows back to today using an interest rate called the yield to maturity. At last, we sum up the present values of all the cash flows and we have calculated the dirty price of a bond. The yield to maturity is given by the risk-free rate for the relevant time to maturity and the maturity-specific credit spread of the issuer. In other words, the yield to maturity is currency and issuer-specific. However, we use a unique interest rate to discount all future cash flows, i.e., we use the same rate to discount cash flows that are 1 year in the future, 2 years in the future, etc. This pricing approach is only accurate if we assume the following. First, the bond is held to maturity. Second, interim coupon payments are reinvested immediately for the remaining life of the bond. And third, the reinvestment rate that is achieved for all reinvestments is equal to the yield to maturity. The last assumption implies that bond pricing is based on a perfectly flat yield curve with a yield level being equal to the yield to maturity, which of course is quite removed from reality, where a flat yield curve is a rare exception rather than the norm. Market participants, however, are well aware of this simplification, so that bond prices by no means are wrong. But be aware that the yield that can be calculated out of the bond price is not a guaranteed total return, as this depends on the future development of interest rates. To simplify the above criticism on the bond pricing approach, one could just say that bond pricing ignores reinvestment risk, as it was assumed that all interim payments can be reinvested at a level equal to the yield to maturity. In practice, interest rates are not stable over time, and in addition to that, the yield curve is not always flat. In case of a normal yield curve, The reinvestment rate for the first coupon payment of a 10-year bond with annual interest rate payments will be lower than the initial yield to maturity, even if the yield curve has not changed in level. This is because the reinvestment will have a time to maturity of 9 years and will therefore only yield the current 9-year interest rate. In derivative markets, the discounting of cash flows is done in a way that is mathematically accurate, which basically means that the reinvestment risk is not simply ignored. Cash flows are not discounted using a uniform interest for all maturities, but every cash flow is discounted with a maturity-specific zero rate. Zero rates per definition are reinvestment risk-free, as zero coupon instruments do not contain coupon payments between the start of the investment and the maturity date. Unfortunately, the market for zero coupon instruments is small and relatively illiquid, mainly due to higher implied credit risk on such instruments. As a direct result, zero rates usually are not directly observable, which makes the zero coupon pricing method a bit more challenging than the simple bond pricing, as we first have to derive zero rates out of the available coupon rates before starting the discounting process. The starting point for both bond pricing using the yield to maturity and derivatives pricing using zero coupon rates therefore is the construction of a curve of coupon rates, as these rates are observable in the market. However, not all coupon rates are directly comparable, as they might differ in liquidity, credit risk, or simply in day count conventions or periodicity. To build a consistent yield curve, we have to use rates that coincide with regards to all three of the selection criteria. Liquidity is essential, as prices and therefore yields of liquid instruments will always react first to a change in market sentiment. For our yield curve being accurate, it therefore is vital to include the respective most liquid instrument available. Exchange-traded instruments are preferable, as they have a central and easily observable market price. The list of acceptable instruments, however, is limited further by credit risk constraints. All instruments used to construct a curve must have similar underlying credit risk to avoid jumps caused by a change in underlying credit risk. The short end of a government bond curve, for example, should not be constructed using LIBOR rates, even if they are probably more liquid for some sample points than T-bills or other short-term government debt instruments. LIBOR rates are based on short-term bank credit risk, whereas government bonds per definition are credit risk-free. LIBOR rates therefore usually are above government rates, and the use of LIBOR in a government curve will lead to artificially high rates. Last but not least, we have to ensure that the rates we use are consistent in terms of day count convention and periodicity. However, this is more of a technical issue, as we can easily transform an interest rate quoted on an actual basis with a semi-annual payment into an interest rate on an actual 360 basis with annual coupon payments and vice versa. Once a coupon curve has been constructed, we have to derive the zero rates. Practitioners generally use a method called bootstrapping, which calculates zero rates out of coupon rates for successive points in time. The underlying assumption of this process is that the first rate given is a zero rate, which is unproblematic, as for example, in a rate environment with annual coupon payment, the one-year coupon rate will be equal to the one-year zero rate, as there simply are no interim coupon payments that can cause reinvestment risk. A formula that is often used and is therefore shown on this slide is based on discount factors. A discount factor can be interpreted as a present value of one monetary unit to be paid or received at a certain point in the future, and is therefore simply calculated by dividing 1 by 1 plus the zero rate for the particular maturity to the power of years. To calculate the one-year discount factor, we can use the given one-year coupon rate at least if we are assuming annual interest rate payments. And using the 1-year discount factor in connection with the 2-year coupon rate, we can then calculate the 2-year zero rate. Using the 2-year zero rate, we are now able to calculate the 2-year discount factor, and the 1- and 2-year discount factors can now be used in connection with the 3-year coupon rate, and so on and so on. But discount factors cannot only be used to derive zero rates. They can be starting point for many other interest rate calculations, like the calculation of forward rates. At the end of our curve construction process, we will therefore have 3 curves: the coupon curve, the zero rate curve, and the curve of discount factors. Swaps are priced applying the no arbitrage principle. The moment a swap is priced, both legs should have an identical present value, which means we have to calculate the forward rates for all relevant 3 or 6 months LIBOR fixings, use them to forecast the future payments on the floating leg, discount these payments, and iterate the fixed rate that will create a total cash flow on the fixed leg with an identical present value. The credit risk incorporated in swap rates, therefore, is the short-term bank risk, as the 5-year swap rate is nothing else than the time-weighted average of the 3 months or 6 months LIBOR fixings over the next 5 years. In connection with the liquidity argument mentioned earlier, this leads to the fact that many banks use interest rate futures or FRAs to construct the short end of their swap curve, as these rates are more liquid than deposit rates. Depending on the liquidity of the relevant derivatives market, we can find curves that are using forward rates as building blocks for up to 5 years. The use of forward rates in curve construction is relatively simple, as we just have to link the forward rates with a spot rate that covers the forward period, i.e. the period from spot to the settlement of the forward contract. The only potential problem is that the rate calculated this way is a zero rate, so that we can't use it to construct the spot curve without further adjustments.